Good afternoon, all, and welcome to our first webinar out of our series of webinars we will be running in the next 2 weeks. Our focus today will be on the credit fund. My name is Ben Arsus. I'm the Director of Distribution at TAMIM, and I'm joined today with the Credit Fund Portfolio Manager, Head of Investment, and TAMIM co-founder, Darren Katz. I'll apologize in advance with my accent. That's what happens when you move 8 countries and speak 5 languages. Many of you already had the opportunity to have a chat over the phone, so wanted to thank you for that. And for those who I didn't have the opportunity yet, I hope I will soon. Our plan today is to run the webinar for approximately 35-40 minutes, leaving us 10-15 minutes for the Q&A. If you check at the bottom of your screen, there should be a space allowing you to raise questions during Darren's presentation. Darren will be more than happy to address them at the end. Also be aware that the webinar is being recorded and we will send the recordings in the next few days. Disclaimer, we put this at the beginning of each of our webinars, just as a reminder that this is not specific advice to you, but rather general advice only. For those who are not fully aware of TAMIM Asset Management, let me give you a quick introduction. TAMIM is a boutique investment management firm. We manage just over $220 million on behalf of around 515 clients. We focus on our endeavors in generating returns to our investors. We tend to look on generating those returns in a slight differently manner to everything else you have in your current portfolio, and they're giving you some good diversification. We focus on 3 different classes, being equities, property, and credit. Within those asset classes, and specifically on the equity side, we focus on Australian investment solution and global investment solutions. And within the Australian solution, we have 2 solutions, being the small cap and the all cap, managed by Ron Shamgar. Ron has been pulling strong returns out of the all cap fund, with calendar year at 18.2% and 1 year number at 33.56%. Ron and his team predict a strong continuous for Q3 and Q4. Australian equity webinar with Ron Shamgar will be on June 25th. If you haven't registered yet, please do so. On our global equity, we have our global high conviction, which is managed by Robert Swift. Robert has generated a 13.6 annualized return since inception. Robert will be here for the webinar of the global equity on June 20th. Last from our equities is our mobility fund, which is run by Ryan Mahon. Ryan used to be a partner at IBEX Mobility Long Short Equity Fund. However, since November 23, Ryan has joined the TAMIM team heading the same fund. The fund focuses on sharing, autonomous, and electrification. These 3 pillars are the building blocks for the future of mobility, constructing a 7 to 10 trillion revolution. Since Ryan joined the TAMIM team in November, we have seen performance improving significantly to as much as 10.3%. We will be hosting Ryan out of Denver for the Mobility Fund webinar this coming Tuesday, June 18 at 10 a.m. Last of our fund is our property fund. Within our property side, we tend to invest in single assets. I like to tell our investors that we like to purchase assets that other people are running away from. Going back 5 years ago, when we were buying shopping centers, people were telling us we were crazy and if we've never heard of the online shopping. Then there was our office building we purchased in Adelaide. Then I think it was, have you not seen the people working from home? And I can tell you, I'm taking the bus and the train every morning to the city, and it's packed. Overall, we believe in change, but strangely enough, we always go back to being the same. We currently tend to focus on office opportunities, but opportunities where we believe we can get those buildings fully leased. And I'm glad to say that we have been quite successful doing so. Just as a quick example, our last purchase was Spear Place, an office building on Curry Street in Adelaide, acquired in 2022, just after COVID. When we purchased the asset, we had 43% vacancy, and after lots of work by our property team, Spear Place is currently 94% leased. Property webinar will be the last in our webinar series and will be headed by Jeff Tate on June 27th. If you haven't received the link with the webinar invitation, please make a request in the question box and it will be sent to you straight after today's webinar. With that, I will pass control to Darren. Welcome, Darren. Looking forward to what you have to say today.
Thanks, Ben. It's always good to be able to be first cab off the rank. Therefore, there are not that high expectations of today's presentation, and let's not kid. It's the TAMIM credit fund, so we always tell everyone that it's the most boring fund that we run. But nonetheless, really interesting area, and hopefully over the next 30 minutes we can enlighten you and give you a bit of education around what we do. So the plan for today's presentation, as I say, about 30 minutes of talking. We'll spend a little bit of time talking through what the current macro environment is. Then we'll move across into private debt and also the rationale for private debt. Why should you be including this in your portfolios? And then finally, we'll spend a fair bit of time talking about the credit fund, the TAMIM credit fund, what it is, what it does, the types of managers, and in fact, also an example of a manager that we invest into. And we'll move forward from there. So pleasingly, we've run this fund now for nearly, well, in fact, 5 years and 7 months to be exact. We've only ever had one negative month in all that time. And interestingly, we're projecting over the next 12 months that we expect about an 8.8% return to investors net of fees. Moving into the first of our sections for the day, the current macro environment. Well, the interesting thing is we've just experienced one of the biggest moves in interest rates in modern history. In Australia, we've seen the move from 10 basis points to around about 4.35% on the RBA cash rate. The moves offshore have been bigger and even quicker. Interestingly, in Australia, the transmission mechanism for increases in interest rates impacting our economy, where mortgage holders make up about a third of the population, is quick, much quicker and much more effective than what you see in the US. And the reason for this is that in the US, you can fix mortgages for up to 30 years. But in Australia, really the maximum time frame that you're allowed to or can fix a mortgage is about 5 years, with most Australians fixing it around about 3 years. Interestingly, we just saw a statistic last week coming out from the Australian Bureau of Statistics, which stated that 98.6% of all new home loans are now being done on a floating rate, which tells you pretty much in a nutshell what the expectations are amongst everyday Australians for interest rates. And that is that they don't expect them to be going up much more from here. In fact, they probably would expect them to be going down. On a rough approximation for most mortgage holders, though, if you were holding a floating rate mortgage 2 years ago and paying 2%, today the interest rate there is over 6%, which means that your payments are roughly around about 3 times higher than they were going back a couple of years ago. This puts or has put a significant amount of pressure on the consumer in the Australian market, although it's important to note that roughly another third of the population in Australia actually owns their home outright, with the last third, just for the record, being renters. So the increase in interest rates for the owners, the outright owners of homes, is that it's a benefit to them. Retail sales in Australia have been under pressure since January 22. And once you actually remove the impact of inflation on retail sales numbers, they've been negative for most of the time since then. In the most recent months, in the last month, retail sales came in at 0.1%, which was really a slight improvement on the negative 0.4 from the previous month. As you can see, the consumer is under a lot of pressure, and discretionary spending is the first place that this is felt. Everyday essentials are normally a little bit more cushioned, and they're still seeing small growth, but that's actually probably as a result of some of the price increases that you've seen coming through the system. Inflation has actually come down quite substantially. Thankfully, we had a peak in Australia of close to 8%. We're currently seeing it around about 3.6%, but the movements down now seem to be a lot more slow than they were about a year back. Despite the slowdown in the inflation rate, or the movement down in the inflation rate, we don't think that there should be any pressure on the new RBA governor to increase rates. But we do note that given Michelle Bullock is a new governor, there may be some nagging noises or voices in her head saying, should I move rates up one more time just to enforce my or her credentials in fighting inflation? That isn't our base case scenario at TAMIM. We don't believe that that's going to happen. We do believe that rates will remain stable through this year, and we actually start seeing in our forecasts cuts in the first half of next year, which is quite different to the likes of ANZ Bank, who came out in the last few days saying that. We've been saying that all year. Offshore, we still believe that the US is going to have 1 or 2 rate cuts still in this calendar year. Just purely, we think that their interest bill of $1.3 trillion per annum is just way too high, and they're not really going to have much choice but to reduce rates, as difficult as that could be for them. Their economy is still is holding up relatively well. In Canada and Europe, we've already seen rate cut moves happen in the last couple of weeks, with 25 basis points coming through in those economies. And across the ditch in New Zealand, we actually think that our close neighbours will cut rates before the end of this year. They've tended to be running about 6 months ahead of us in Australia in terms of their economy. Interestingly, from our perspective, and a good observation to make here, is that with that kind of a view around the macro environment, we think that it makes a lot more sense in our credit portfolio to be picking up as much fixed rate exposure as we can, given that we think at some point in the next 6 to 12 months, rates start coming off. Last week we saw GDP came out, or the GDP number come out at about 1.1%. That starts panicking everybody and brings about the dreaded R word, recession, puts it back into discussions. To be fair, it was the lowest GDP print that we've seen in the last decade, excluding the COVID shutdown or meltdown, or whatever you want to call it. Unemployment in Australia is currently running at about 4.1%, and while that's indicative of a fairly strong economy and still a low number, it is up from its August lows from last year of 3.4%. And anecdotally, the news and the conversations we were hearing from around the marketplace is that unemployment rate's expected to increase over the next 12 months. As far as business lending is concerned, within the banking sector, it's still under pressure, and most banks are still very much focused on residential mortgage lending, which probably to us in the private debt space makes us happy. It gives us a gap to get into the market and find great investments. Sectors that we like are agriculture, manufacturing, mining, and transportation. They're still showing strong growth, and the places where you're seeing a bit of struggle still coming through is construction and office real estate from a debt perspective. We have tried as much as possible to stay away from construction in our private debt portfolios, and where you do pick up construction, you're looking at picking up stuff that's very close to completion. So what is private debt? And I suppose, having moved through that economic background, we move our discussion to the private debt side of things. And really, with rates being at zero or very low since 2008 in Australia, and globally, we, and by that I mean the TAMIM investment team, myself and the people that work alongside me, really struggled with the idea of allocating to bonds to get our fixed income exposure. We knew that somewhere along the cycle we were going to face a situation, and it took a lot longer than we thought, maybe in terms of it happening. But eventually in 2022, you saw a massive spike in inflation, and obviously interest rates moved up dramatically from then. Now, anyone that understands a little bit about fixed income or fixed interest securities will know that when interest rates go up like that, the face value of those bonds decrease, and you potentially suffer or can suffer capital losses. So we were staying as far away as we could from bonds, whether they were government bonds or even corporate bonds, for a long period of time, and really trying to find a place in our portfolios where we could allocate a fixed income exposure. And that really got us looking at private debt as an interesting alternative. We really liked what we saw, and we moved ahead with that. So what do we mean by private debt? Well, the first point I just want to make to you is, quite often you're going to hear the terms private debt or private credit, and they seem to be used quite interchangeably. There's a slight difference in the definitions, but arguably for the purposes of this presentation today, we'll talk about private debt. So today in Australia, we think that private debt is considered to be a mainstream investment asset. In fact, today's webinar, in terms of registrations, was as popular as our Australian equity webinars. And to give you a bit of disclosure, our Australian equity webinars are normally exceptionally well attended. We can get anywhere from 400 to 500 people coming to that. So while we probably haven't hit 400 to 500 in the private debt conversation today, we're pretty close to those types of numbers. So there's obviously a lot of interest in the space, and everyone that we're talking to when we were getting out into the marketplace, from family offices to mums and dads, are investing in private debt in some way. So what exactly is private debt? Effectively, it's describing something usually money, which is owed by one particular group of person to another particular group of person. Basically, it's a transaction where a lender provides a loan to a borrower. And those loans are non-bank loans, which means that the lending party is not a bank. Importantly, that doesn't make these loans more risky as most people would potentially believe. And what we found is that actually the banks have stayed away from the space because they've tended to be much more focused on their residential home loan lending businesses. Also, these types of loans have tended to be smaller and maybe a little bit more complicated. So within the banking environment, where they have fairly rigid guidelines and checklists that they have to follow, it just becomes more difficult for them to manage it. They're staying away in most instances as a result of them being more complicated and less profitable to operate for a bank, rather than operating that residential home loan business. Private debt, in terms of our conversation, has a number of characteristics that make it really interesting, and a strong candidate for investment and inclusion in investment portfolios. The reasons or the characteristics are as follows from our perspective. The loans we see are typically individual and unique, and as a result of this, they can be tailored to the benefit of the lender from a security of capital perspective. This is normally done through underlying collateral or security, so we tend to be secured in the loans that we write, and also they can be protected by the provision of covenants or safeguards inside of lending agreements to the lender's benefit. Assets generally provided as security are hard assets, and in Australia, this collateral quite often tends to be in the form of property. Sometimes you'll see business assets or otherwise even business cash flows being offered as collateral. The loans can be structured to sit pretty high up in the capital stack, and are quite often senior secured. So that means they're sitting at the top end of the capital stack, and equity, which is generally quite a common investment asset class for us, will sit at the bottom of that capital stack, with mezzanine type loans sitting somewhere in the middle of all of that. Loans are often also accompanied by personal guarantees from borrowers. The one downside that we do talk about within private debt, and something to be quite aware of, is that the loans tend to be quite illiquid, and that does give us the benefit of better returns of them. So that's the upside of that. But the one thing to always remember is that you're typically going to hold these private debt investments for longer periods of time, and typically the underlying investments that we'll see out there are not necessarily easy to exit prior to their defined exit periods. Looking at the next slide, what you'll notice here is that there are a number of different types of private debt. These vary from unsecured to various kinds of property lending and even lending against business cash flows. In the early days of private debt for us at TAMIM, we ran a number of closed-ended funds which focused on unsecured lending, and that, while it was very successful, was definitely a good education for us. And we quickly learned that bizarrely you could actually get better rates on loans which were secured rather than unsecured. What we also learned at the same time was that in Australia, the level of protection given to lenders in an unsecured transaction was really poor. In our due diligence over some of the underlying loan portfolios, quite often what we noticed within these unsecured loan platforms and lending managers was that the credit work done tended to be quite systematic and actually was quite substandard. For example, the one time myself and Jeff were out at a manager, and we'd actually seen borrowers being granted loans when actually they should never have been given these loans. A simple review of their bank statements indicating deposits into gambling or betting accounts. So to us, that was a massive red flag. And the other key thing that we picked up there on the unsecured lending businesses was on the recovery side, given that the loans written were generally pretty small in size, when a loan went bad, it was normal that they actually it was too expensive to recover against that loan through a legal channel. So quite often what you'd find was the lending managers would sell those loans to other parties at 30 cents on the dollar and recover as much as they could. So with all of that said, today we tend to stay very far away from unsecured lending. It makes a lot more sense to us to go into the secured space, where we actually generally get a better return. With lending, which is secured by property, we find we're able to tailor strong security around the loans with loan to value ratios typically around about 60%. And there's a good legal system in Australia which allows you to take ownership of property security if the borrower tends to default. Interestingly, we also find some good loan portfolios which focus on business cash flow lending. One of the good examples to give here is in one of the loan portfolios which we've invested into, that portfolio had historically lent funds to a recycling business which had a number of contracts with local councils for recycling. That particular business had actually gone to the banks and looked to try and actually get that loan funded by or within a banking environment. But the banks, when they looked at their checklists, one of the key things that the banks were saying is the business had to be in operation for more than 2 years before they'd lend to them. And in this instance, the actual new company had only been operating for just over 12 months. So despite the fact that the operators of this business had run it in a different format historically for years previously, and despite the fact that they had 5-year locked-in contracts from local government bodies, the banks wouldn't lend to it, wouldn't actually go through with the loans to them. So the private debt parties stepped in and took advantage of this, lending funds to the business. And I don't really need to tell you the loans never missed a payment, were repaid on time at the end of the loan period. And as investors into that platform, we generated some good returns out of that. So now that we've given you a broad overview of private debt, I guess the question is, what's the rationale for private debt? Why would you want to hold it in a portfolio? So to us, the first reason for investing is always attractive risk-adjusted returns. And what we're finding with private debt is that it's possible to generate stronger returns than you would see normally in traditional lending products such as bonds. The returns are often in the form of stable and regular interest payments, which is always nice for a portfolio, especially when you're retired or about to be retired. And in some cases, the returns you're seeing here are actually quite commensurate with what you're seeing in equity investments or traditional equity investments. So that's always good. Secondly, we like to earn returns in portfolios, as we always say to you, and I think Ben actually mentioned it in his introduction, that are very different to the other returns that we're earning from other investments we hold. And private debt brings some really good diversification. These investments, while they're not risk-free, tend to act in a very different way to your traditional asset classes, such as equities or even property. And that means when you put them in your portfolio, they actually help you to lower your overall risk due to that diversification. You're also able to get exposure to different markets and geographies, which further increases your portfolio diversification. A third reason is the strong capital preservation qualities built into private debt transactions. And we're always quite careful to talk about capital preservation. The authorities tend to get quite upset with you when you mention capital preservation around investments. And we're not saying to you that you're guaranteed not to lose capital. There's always risk with investing. But tied into this, you have a very strong ability in lending to secure the loans against collateral such as property, equipment, or receivables. And depending on your loan to value ratio in the collateral, this should help to protect your capital in terms of the loans that we're making in the case of a loan default. The inclusion of covenants, which we'll talk a little bit more about later in this presentation, also gives an extra layer of protection to the portfolio. Another really interesting reason for looking at the inclusion of private debt in portfolios is the protection that it will give you against inflation. In an environment of rising inflation, the ability to structure your portfolio in floating rate loans definitely helps protect you against that inflationary environment. So what you would expect to see is as the central bank increases the cash rate, the yields delivered on floating rate loans obviously will increase at the same time. And even when your private debt portfolios are invested in fixed rate loans, which across our private debt portfolio we see a bit of a mix of the two, what you find is that these fixed rate loans will tend to roll on average just over sort of every 12, 13 months. So when they're rolling across into new loans or new opportunities, you're resetting at a higher level anyway. So you tend to move your interest rate up in that inflationary environment quite quickly. And then finally, one of the last rationales around private debt is they actually tend to be, because they're in private markets, they tend to give you very unique opportunities. Because private markets are less efficient, obviously, than public markets, or at least they should be in most instances, that'll allow the situation whereby skilled managers or lenders can come in and take advantage of a mispricing of risk and generate strong returns for ourselves. So before I move on to talking in more detail on the TAMIM credit fund, I might just take a few minutes for a discussion around what we believe is one of the more interesting and important features we see in private debt, and that's the ability to structure loans to include covenants which protect us as lenders or investors. And my apologies, I know we're showing our true colors as you know, investment nerds, as we quite often get called by our relative spouses. To us, this is a really interesting area, and I thought, probably a good one to include in today's presentation. So we've said it a number of times in the presentation and talked about the ability to structure private debt deals to provide strong levels of security on underlying collateral. And the protective covenants that we see are provisions that are included in loan agreements to help us safeguard ourselves by imposing obligations on the borrowers in this instance. As you can see on the slide, the four common types of covenants that we typically see being used by lenders in their loan documents are firstly financial, then operational, affirmative, and finally restrictive covenants. A lot of these clauses or covenants are actually really just common sense, and you'll probably pick that up as we go through it now in the next few minutes. But when you leave them out of agreements, they will quite seriously or significantly weaken a lender's position. So within the financial covenants that we see in agreements, we typically will see clauses that refer to debt servicing abilities, and debt service to coverage ratios will normally force borrowers to keep a certain amount of income or earnings in relation to the costs of debt or interest payments that the borrowers are making. This type of clause normally gives a lender confidence that the borrower will be able to continue to service their debt payments. Leverage ratios also fall into this category and serve to limit the amount of debt that a borrower can take on in relation to their equity or earnings. In the next area, which focuses on the operational side of a borrower's business, it's common to see agreements which would include provisions stopping borrowers from pledging assets such as collateral to other lenders. And that helps us ensure seniority in the lending capital stack. Quite often, you're going to see lenders preventing borrowers from selling significant assets without the consent of the lender, and that's the limitation on asset sales. In terms of the affirmative covenants, it's normal to see lenders requiring regular and detailed financial reporting from borrowers, and we're often in the position where we can enforce certain insurance requirements on borrowers, which is always nice, to make sure that they protect their ability to service loans and repay capital. And then finally, we'll sometimes see provisions whereby lenders will restrict the ability of businesses to pay dividends or distributions to the equity holders, and also potentially restrict the ability of the business to go out and seek further debt funding. So as you can see from the slide and the discussion on covenants, the private nature of these loan agreements allows us as lenders to better manage and mitigate the risks associated with lending to private companies, and the covenants provide a mechanism for ongoing oversight over portfolios and help ensure that the borrowers maintain financial discipline and stability in their portfolios. So this brings our conversation around now to the TAMIM Credit Fund. And as we said earlier, we established the fund in October 2018 was the establishment, but we've been running, as we'd said earlier, for 5 years and 7 months now. In that period of time, we've seen a crazy world. We've seen COVID, we've seen inflation at the highest level in decades, and we've also seen a massive change in interest rates, and all that time has seen us across this portfolio only experiencing one negative month. So really happy to see a portfolio acting in a really stable, robust fashion across a pretty volatile investment environment. To give more context on that negative month, it was actually less than 0.5% down. So pretty happy with that performance. We've paid quarterly distributions every quarter since inception, and we're currently, as I said earlier, seeing a 12-month forward-looking outlook of around 9% after fees. Roughly 85% of our portfolio is in senior secured loans today, and then about 5% in mezzanine loans, with around about 10% of the allocation in cash. And then across the portfolio, which is invested into loans, so excluding the cash conversation, roughly about 81% of those loans will be secured by property, and then around about another 19%, the balance is secured against business cash flows. The TAMIM Credit Fund focuses on funding loan books for various funds or platforms in Australia that source secured private loans and credit opportunities. In today's environment, we're looking to beat the 3-year annualized RBA cash rate by around about 3.75% as an investment objective. We believe in the credit space that you need to be invested. It's really important this with experts and certainly bigger investment managers, stronger hands. And as such, the credit portfolio is structured to invest in or fund loan portfolios of experts in various private debt segments. Overall, we have investments into 11 loan portfolios or credit opportunities, with 5 of those positions being what we'd consider to be major positions. The other 6 tend to be single opportunities or actually managers, which we hold really small allocations as part of our due diligence process. Assuming that these managers pass the due diligence, then we expect those position sizes will grow across time. And our thoughts and expectations are that over the next couple of years, we get ourselves up to no more than 10 major positions across the credit fund, and we'll still include some smaller opportunities around this. The portfolio looks to be diversified across geographies, lending types, underlying security, and industries, and this helps us to deliver a consistent and stable monthly set of returns and to keep on hitting our quarterly distributions. So really important here, and I might just sort of pause before I get into the due diligence process that we go through, just to remind you, if you've got any questions through this presentation, please just put it into the Q&A box. I'm really happy to answer them all at the end of the presentation. And also just a reminder, we're recording today's presentation, so you will get a copy of this over the next 24, 48 hours, I would expect. In terms of our due diligence process, as described on this slide, we very much focus on what we call the 4 Ps. So that's people, process, pedigree, and performance. And to be fair, I don't really need to run through on the slide what each of those different areas means. I'm more than happy for you to take a look at that as I talk, or when you see the recording over the next couple of days. I wanted to, on this slide, talk more about the 3 key areas that we focus on very strongly when we do our due diligence. And those 3 key areas are credit, legals, and experience, or as we like to refer to them as battle scars, which is always funny. So firstly, when we look at a prospective investment, we look at its credit process, and really that is very much a key factor, and it's the first building block of our review. The reality is, if you can't assess credit quality of a borrower correctly, then you really should not be running a lending business. So really important. But in all fairness, it's really the first stage of what we go through. And more importantly than looking at that credit process in our due diligence, we look at the legal side of the business. And what do I mean when I say legal side? So we want to look at the team that works there, and we want to look at the legal documentation that they operate, and we want to understand that they have a very strong legal ability and that their legal documentation is clear and concise and gives them a strong ability if something goes wrong, because let's not kid, things always have a funny habit of going wrong. So we want to make sure that if something goes wrong, they have a very strong ability to step on the underlying collateral that is being used to secure the loan and take control of it. This collateral could be property, could be other real assets, or even contractual cash flows. But at the end of the day, we want to satisfy ourselves that the lender's legal documentation and their team's ability is strong enough to protect them in the situation of a failure. And then the third level that we step up, which is again more important than the legal side, and probably a little bit more of an art in terms of this due diligence process than most of the other items, is we want to understand the lender and their team and their ability to deal with tough situations. So there's no point in having the best credit system, and there's no point in having the best legal documentation in the world if your team just does not have the capability to deal with a default situation. And let's not kid, I'm not sure if you've been through those types of situations yourselves, but not everyone is made up to deal with a difficult situation or event of a default. And we always say that from our perspective, our managers need to be highly experienced, and we like it when they've been through bad experiences. In fact, we like it so much that quite often, if we find that the team hasn't been through a debt default cycle or hasn't experienced bad debts in the teams that they've worked in historically, then we typically will actually pass up on investing with them. We like them to be able to demonstrate the transactions that they've found difficult. They need to be able to talk us through what they've learned through those situations, and we need to understand the actions that they took to protect their loans, because ultimately we're going to be the parties that are funding their loans, and we want to make sure they can protect us. So in short, we want to see their battle scars. So with all three of those three things in place, we get comfort to proceed with funding a loan book. On an ongoing basis through the due diligence process, we look to build deep relationships with the various loan platforms and lending managers that we invest into. And importantly, we maintain a regular program of review around their operations. So taking a closer look at the TAMIM Credit Fund, talking about one of the underlying investments and managers that we work with in this portfolio, I think it's quite important to give you a bit of an insight into the types of managers and people that we invest with. This particular manager has been invested in, or we've been invested in through the life of the portfolio, around about 5 years now. Their name is Equasia, and as I say, they've been a key part of the credit fund since we started our portfolio. They've built out a diversified portfolio of private debt and targeted returns of around about 10% per annum. They've constantly delivered a strong performance with pretty low volatility, and the key benefits to the TAMIM Credit Fund have included them bringing diversification, capital preservation capability, and also an ongoing professional management of the loans that they would fund. They tend to follow a private debt strategy, investing across a number of industries and sectors. They will leverage their strong in-house credit analysis capabilities, and they also have a pretty unique network of deal origination capabilities. As I said, over their 5 years of operations in this particular fund, they've hit their targets of 10%, which we're quite happy about. Not only have they been strong performers, but the capital preservation qualities have been good. They've only ever had, similar to us, one negative month in their portfolio. And actually, interestingly, that negative month they had in our portfolio in the TAMIM Credit Fund, we were positive that month, which goes to show you the benefit of diversification in our portfolio. The manager is relatively small in comparison to some of the big shops out there, and they're focused on deploying cash correctly. So they won't take in cash, sit in it for a long period of time, because they understand that creates a drag on performance in terms of the funding that we provide to them. The loan portfolio they run has very limited construction exposure, around about 6%. But that construction exposure that they're holding in the portfolio is largely in completed projects, and they do tend to have a fairly diversified asset allocation position. Their lending team focuses very much on real estate lending, and that sits in the residential, industrial, and mixed use space. They also have other investments across opportunistic credit, specialty lending, and convertibles. Their portfolio at the moment is invested into about 23 loans, and the weighted average life of those loans is just over 17 months. So that means every 17 months on average, we'd expect them to be in a new set of loans. They've been moving away from mezzanine loans, and they've been moving themselves up the capital stack towards more senior secured lending over the last 12 to 18 months. And in the first quarter of this year, they had 7 of their loans repay, and they issued 3 new loans with about $184 million of capital commitments coming up for them over the second half of this year. So moving this discussion back to our credit fund, we, as I have said through the course of this investment, we have investments into 11 of these types of credit opportunities or loan portfolios. And we're currently in due diligence around another 2 additional investments. Now, quite important to note here, that due diligence process does actually take time. And interestingly, we do use that time as a due diligence method for ourselves as well. So you'll go into the manager or the loan platform, you'll do all your reviews, you'll look at their credit, you'll look at their legals, you'll understand their team. And then typically what we'll do is we'll make a pretty small allocation to them and leave that small allocation with them for a year or maybe even a little bit longer than a year, because what you find through that period of investment is, are they doing what they've told you they're going to do? Are they reporting correctly? Are they giving you further information? Are they transparent around their loan portfolios? All of that kind of information is really important to us. And if we're not seeing that, then typically we won't move forward with a new investment. Across the overall portfolio, the TAMIM credit fund portfolio, we have exposure to just over 450 loans. The largest of those loans being 2.9% of our fund. The weighted average duration of the credit fund is around 13 months, and the weighted LVR is around about 63%. We tend to be very much focused on safety and security, with senior secured loans and cash representing just over 95% of the fund's allocation. As you can see from this table, the returns across the life of the fund have been remarkably consistent and secure. The last 12 months, we've seen a return come through at 8.55% net of fees, and we think that we're well placed to deliver close to 9% in the next 12 months. The fund, from a distribution perspective, has never missed a distribution since its inception, and those distributions have ranged in value from 1.4% to 2.2%, and in fact, actually the last quarterly distribution was at 2.2, which is the highest we've seen over the life of the fund. We do expect that to drift a little bit higher in the next few quarters, so that will be interesting to see. In terms of the key facts or sort of investment metrics that you need to be aware of for the TAMIM credit fund, it is run through an unlisted unit trust structure. Minimum investment is $100,000. We do take applications on a monthly basis, and redemptions are available quarterly with 30 days notice. We price the portfolio monthly. Important to just note, it tends to take us a little bit of time post month end to get that pricing out, which is quite different to most of our other investment solutions. We tend to need to wait to get those valuations through from the underlying loan portfolios or investment platforms that we're funding. In terms of distributions, we'd mentioned quarterly management fee on the portfolio is 1.25%. Our buy-sell spread is 20 basis points on entry and exit, and that doesn't go to us; it goes to the benefit of the portfolio. There is no exit fee, and we tend to say to people 3 to 5 years is the investment horizon to consider when looking at this portfolio, although it makes sense to hold for a lot longer than that. And if you're reinvesting distributions, you get the benefit of compounding coming through on the portfolio then. So in closing for today's presentation, I thought probably it made a lot of sense to discuss why the TAMIM credit fund is really deserving of your attention, and we do thank you very much for taking time out today to listen to us, and why you should be including this fund in your investment portfolio in comparison to other asset classes, and also in comparison to other private debt alternatives that you might be seeing out there. And first, as we always say, and we've said it a little bit earlier in this presentation, there really is only one reason to be investing, and that's, as always, to generate a return. So in this portfolio, we've consistently delivered on this front, and we expect that this continues to occur on a go-forward basis. We're looking at delivering around about a 9% return on a go-forward basis over the next 12 months, which we think is really a strong set of returns. Secondly, again, as we always say to all investors, returns are good, but it's even better when you're getting those returns delivered in a very different way to the other assets you're holding in your portfolio. And the private debt portfolio does do this very well. It acts very differently to the equities and property and even fixed income that you're most likely to have in your portfolio already. So that means that by adding the TAMIM credit fund to the portfolio, you have a fairly decent chance of improving returns, but also definitely there's a very strong chance that it reduces the overall risk of your portfolio as well. The consistency of returns on the portfolio has been pretty exceptional, and the easiest way to demonstrate that is the one negative over its lifetime. The TAMIM credit fund has, as is designed, been focused to invest with top tier lenders, and we're constantly sourcing the market and have developed a stable of what we believe are the best loan opportunities, private debt opportunities in Australia. It's likely that most investors out there are not going to be able to find the investments that we've found, both in the portfolio and in our due diligence process currently. Secondly, even if you're able to find them and source them, in a lot of instances, what you'll find is those managers are not open to new investors today. So the access provided to top tier managers or loan portfolios from the credit fund is really strong. And then the third point to make here is that even if access was there, the minimums typically into each of these underlying investment opportunities are typically high. So being able to put together a portfolio of 11 different and diverse investments would be pretty impossible to achieve with a $100,000 investment. At the TAMIM side, we run a really professional investment business, and as such, we do a very high level of due diligence and investigation before investing into any loan portfolio or opportunity. Once we've invested, we continue to run ongoing due diligence around these investments. So what the TAMIM credit fund will do for you is remove the headaches of finding those assets, doing the work around whether they're good or bad, because the difference between good private debt managers and not good private debt managers tends to be quite large. The credit fund is an open-ended investment, and unlike most first mortgage opportunities that you're going to see in the marketplace, the investments are ongoing with no set maturity dates. The key issue that we quite often will see for investors is when they invest into these single loan first mortgage opportunities, besides the risk of being in just one single deal with one single set of security that's going to be exposed to very specific sets of risks. At the end of that loan, what's going to happen is you're going to get paid back your cash, and you're going to be earning a cash rate while you're looking for your next transaction. And certainly if interest rates are moving lower, the next set of interest rates are going to be lower than you're currently earning. Finally, the TAMIM credit fund is a unit trust investment, so you're not going to be getting unnatural equity risk in your private debt allocation. So if you're coming into a LIC or even potentially an ETF, you're going to get a level of equity market risk inherent in your investment. And the other point is we don't leverage the portfolio like we see with other investment opportunities in private debt. So that additional level of risk is not added to the investment. The TAMIM credit fund is fairly simple to enter and to exit, and the administration around it is pretty easy, certainly from a tax reporting perspective as well. So at that point, I think I've probably exhausted my my talking slot, and I think Ben is well and truly fallen asleep on me. So I do thank you for your time today and appreciate your interest in what we do. And hopefully, if you're an investor, we can continue to deliver strong returns for you going forward. Or if you're considering an investment, we look forward to starting that journey with you. At that point, I'm going to hand back across to you, Ben. I don't know if there's any questions. I think we were very thorough and covered off all points, so maybe not.
Darren, we got a few questions. I'll jump straight to them. First question, and again, if I don't tell all the questions that there is, we will come back to individually with answers. What are the risks you foresee in the fund?
Ben, okay, good question. I think if you look at the presentation that we had today, we've talked a lot about the benefits and the good things that you get out of investing in a private debt portfolio. So what are the risks that we see specifically to this credit fund? And it's actually quite a tough question to answer, because there are risks involved here, and certainly we're not saying to you that this is a risk-free investment, but it's pretty different to the risks you're going to see in an equity investment or a property investment. I think some of the key things you've got to be really aware of here is, number one, the liquidity around private debt underlying, so the stuff that we're investing into is pretty low. So you need to understand what that liquidity risk does to your overall portfolios. And if things go wrong, it can take a period of time to work through some of these loans. So that is definitely a risk you need to be aware of. I suppose probably not necessarily the best answer, but the other key thing that we always look at is valuations of underlying securities. So given that we focus very much on investing in loans which have senior security or mezzanine security in some instances, but mostly senior security, it's very important to understand the valuations around those underlying assets and have those valuations been done correctly. So certainly risks that you foresee out there, and these are things that we work very hard to mitigate, are that valuations on underlying security have been done incorrectly, which therefore means that your security may not be as good as it could be around that loan. But it definitely, from our perspective, it's something that we focus on and we try to prevent going forward. Other key areas, and the place where we had a negative month, even though it was 0.5% down, is there's always going to be a potential where a loan is made into a transaction that could potentially be illegal or fraudulent. And again, we work very hard with our managers to make sure that those types of things don't happen, and you mitigate those risks again by ensuring that you have very strong collateral on your underlying assets or your loans.
Thanks, Darren. Appreciate it. Got a question here. What is the fund minimum investment? I'll actually answer that. The guideline is 100,000. However, I'm happy to have a conversation with any prospects around the amounts that they're comfortable with, as long as they qualify as a wholesale investor. And also, if I may add, we do allow 100,000 to be split in a few asset classes. So let's say 15 equities and 50 in the credit fund. Just give us a call. We're always happy to assist and get there. Here we got another question for Darren. Do you see a recession happening? If that happens, will it negatively impact the fund?
Ben, yeah, look, again, I think a fairly good question. Certainly, there is a fairly strong chance of a recession coming up in Australia, we think. Although maybe it doesn't actually occur, you might just see a weaker economy, and I think we're already probably experiencing that with most Australian mortgage holders having a pretty tough time out there at the moment. The reality is we've run this fund now for, as I say, 5.5 years. We've run the portfolio through COVID, which was probably the toughest economic environment certainly I've experienced in pretty close to 30 years of investing now. And even through that kind of an environment where the economy actually literally shut down, we didn't see anyone coming through in the portfolio and actually ended up defaulting on any loans. So yeah, a weak economic environment is something that we will watch and we will be aware of. But again, because we tend to be invested in senior secured loans which have got strong underlying security and protections, we think that we come through that fairly well. But again, we're always on high alert to manage what's happening across the portfolios. Ben, I can see that there's a few questions coming through, and I might actually just grab them off the screen rather than having to irritate you into reading them out. But I'll run through them quickly. So there's a question here about the risk-adjusted returns that we've been delivering and whether that's exclusive of fees. The good news is that number that we talk about is always after fees. So that's a net of fees number. So over the last year, 8.55% per annum return to investors, and that was after fees. So really good returns there. In a falling interest rate environment, what do you see as the yield, say, a year or so out? Tough one. we tend to be quite conservative in the way we look at these things and model. I know that we had a property transaction we were modeling in a different part of our business earlier in the year. out of conservativeness in that property transaction, what we modeled was actually interest rates going up by another 25 basis points this year. But I think that was just us being conservative. I don't actually see that happening in practice. What we do think is rates will stay stable as they are till the end of this year, and then it's likely that in the first 6 months of next year, we're going to see probably 25 to 50 basis points of cuts. So I would say our view is that we're going to get something like 50 basis points through 2025, depending on the severity of what's happening to our economy, and what we're talking about is a slowdown in that economy. But yeah, our view is roughly about 50 basis points through the course of next year. If it's more than that, then certainly things would be pretty tough out there. Next question here. Why is it a good deal for us to pay TAMIM an extra fee on top of the fees potentially on other underlying investments? I think that goes back to what we talked about earlier on. So in a lot of instances, when we go out to big family offices, groups where they have 50 or $100 million to allocate across markets, then they typically will be able to find and get access to the investments that we're picking up here at TAMIM. But I think for most of us, we certainly do not have that level of money to deploy into markets. So I think there's a few things here. One is we're able to source really good managers. Number two, when we source them, we're able to get the access to those managers and their investments. That's not always going to be available to everyone else out there. And I think probably the third point, which is really a strong point on this matter, is putting together a diversified portfolio. So as I say, we have 11 investments in the TAMIM portfolio, over 450 loans in the portfolio, and they're all done in different places, right? So we've seen managers where a manager might have in their portfolio 1,000 loans, but they're all done in exactly the same place. So you're not actually getting a proper level of diversification in that particular instance. With the TAMIM credit fund, what's actually happening here is you're getting loans across business cash flow lending, property lending, first mortgages in a number of different areas. So you're actually getting a really good diversification across the portfolio. And I think ultimately probably makes a lot of sense to us that, that offer makes, it's a good offer to investors. I think the last question, maybe I've got time for one or two more, but in terms of, there's a question here around the valuations on underlying securities on the loans. Do we carry out those valuations, or will we rely on the valuations of the loan platforms that we invest into? In some instances, we will carry out the valuations, although that is fairly rare. The good thing for us here is that we run a significant property business within TAMIM. So we understand property exceptionally well. And when we're looking at the different loans or opportunities that we get crossing our desk with valuations around property, it's pretty easy for us to get in there and assess whether those valuations make sense to us or not. But again, then typically in our due diligence process, one of the key things we'll look at is what is this platform or manager's capability in terms of doing a valuation or a correct valuation on an underlying piece of collateral. And if we don't get to the point where we're comfortable around the valuations they're putting on things, we just simply won't invest with them. It doesn't make sense to us. So it's really important that either we're going to be able to understand the valuation on an underlying collateral, or we need to understand that we have comfort on the investment party's ability to do that valuation. And then last one is, what is the size of the fund now? We're a boutique. We're still fairly small. The portfolio that we run in the credit fund is pushing close to $30 million today. And to be fair, that's been done out of conservativeness. So what's really important to us is that we don't take in a big amount of money every quarter. So we do actually limit the amount of money that people are able to give us in the credit fund, because what we want to be sure of is the ability to allocate that investment and not leave it sitting in cash. And I suppose when interest rates were sitting closer to 10 basis points or thereabouts, that was even more important. So probably a little bit less important today, but really important to us that we deploy investment funds in a stable, well thought out fashion. So yeah, that size will grow over the next few years, but we don't ever envisage the portfolio being bigger than $100 million across time. So I might actually stop over there. Ben, I'm going to hand back to you maybe just to close out for today. I think the one thing I did want to say before I hand it across is I'm pretty proud of the guys at TAMIM. I know that we run an investment team and we run an investment business, but they're also quite concerned around the world around them. And the team has actually just recently entered into the push-up challenge. So if you ever come past the office in the next few weeks, you'll see a whole lot of people doing push-ups in the path in the passageways. And if anyone wants to support them in that endeavor, please let us know. We're happy to give you the links to make a donation to that challenge as well. So thank you very much, everyone. I'll stop talking there.
Thank you, Darren, for your insightful presentation. I know we've all gained valuable insight from your talk. Application forms and information can be found on our website, www.tamim.com.au/credit, or you can contact Darren, Sid, or myself at the office or on my number 0403 360 850. Thank you all for your time, and I look forward to welcoming you as an investor at TAMIM.